Good morning, everyone. This is chapter one. As I said, I will record important things. You will get it in Google Class. Okay, the things that I feel it will be not enough in the class. Okay, I want you to go back to Google Class and listen to it again. So some of you just joined yesterday, so they have missed 5 chapters. That's fine. You will get everything, all the resources, all the notes on this Google Class and this recording. So just I'll start with chapter one, which is obviously an important chapter because it's the beginning of this F3. So what we are going to discuss in financial accounting, let's imagine that you own a business, you started a business, okay? And in any business, on daily basis, there are some transaction happening. So these transactions are supposed to be recorded. Now, depending on your type of business, recording the transactions and creating statements out of these transactions are mandatory for some kind of businesses, and some it depends on the owners if they want to do it or not. But some are mandatory by law. For example, limited liability companies, okay, شركات ذات مسؤولية محدودة in Arabic we call it, that companies are required to, record all their transactions. In Bahrain, WLL companies are also required by law to do this, record their transactions and create financial statements. All that they are required to do. So why other reason for us to do this is, at the end of year, you as a business owner, you want to see how much you own in the business, how much cash you have in the account, how much your supplier owe you, how much the customer owe you. So all this you want to know. So that's supposed to be recorded. That's supposed to be got recorded by your accountant. Okay. Now, if you have studied accounting in school or university, I just want you to forget what you have studied, because now we want to learn it as ACCA want us to understand, okay? So we will see accounting as a coding. We will see accounting as process of accounting as coding and procedures or steps that we will follow as it is, okay? So accounting is just a simple coding, converting transactions into code language. Our code language will be basically debit, credit, okay? Next, debit, credit are created. Let's now, I just don't want you to try to make, logic conclusion of what I'm saying, okay? You just keep in mind that debit credit, what I'm talking about, is created by or created out of formulas. Okay. There is a logic, but by time you will understand the logic. But now, for now, you understand it as it is a formula, and we are applying this formula. We will learn rules to which will, which things that will do debit, which will do credit. We will create ledger, which is also a coding from which we can see each transaction and create trial balance. So these are some steps which will take us to create at the final the statement. From this, we create statements, balance sheet, income statement, and cash flow. Now, balance sheet, we studied, we call it balance sheet, but in ACCA, we call it statement of profit and loss. Income statement, we call it profit and loss. And balance sheet, we call it financial position, statement of financial position. Okay. Accountants work in to create this statement without interfering in business. So now accountant, whoever is an accountant in a business, his work is just to create these statements. He does not involve in, how to make the business profitable, how to reduce cost. This is not the work of accountant. The accountant just wants to make sure that he's recording everything and presenting this information to the users. We'll talk about the users. Who are the users of this statements. The concept that we'll cover, what is debit credit rules. Then we'll create journal entry. Step 2 will create ledgers. Step 3 will create trial balance. And at the end, we'll create this statement that we are talking about. We will create it. There are five main terms that I want you to understand. Okay, five main terms, which we will see it in the whole F3. They will come up in the whole F3. So, and each item in F3 will come under this main categories. Okay, so first of all, we have assets, liabilities, expenses, income, equity, or capital. We call it equity or capital. All of this is in FA, or all the items in FA will come under these categories. First of all, assets. Assets something that we own. It is used in business. We have ultimate control over it. The assets, for example, building, car, furniture, cash, bank balance, receivables, receivable, which is credit sales. Okay, these are business assets. Okay. Now, this is a simple definition that I have kept you on this slide, but then the definitions which you need to go is which is in the book. Okay, definitions. If there is some, if I tell you there is a definition, you have to go back to the book, which is available also in your Google class. You have to study it from the book. We'll go through the book also, but I just want to give you some main points in this chapter. Next, we have expenses. Expenses, we pay for the service when we don't get the asset. Now, expenses, how we differentiate between asset and expenses? Expenses, we need a service, we need a product, but we pay for it, and then we don't own it. That is an expense. Okay, for example, salaries, rent, telephone bills. Okay, at the end, we are not owning anything. So that is an expense. Liability, some amount we need to pay in future. Okay, amount we need to pay in future, like loans, payables, credit purchase. Payables is credit purchase. We purchased some items on credit. Income, amount earned not to be paid back. That is what we have earned, and we are not supposed to pay back to somebody. Okay, we can use it as we wish anywhere, which is opposite to liabilities. Okay, income, that we own it, that we get it, okay, in the business, and we have the control of it, and we can do whatever we want from this income. Equity. Now, the business, when we talk about business can be funded in two ways. Okay, either the founders of this business, they are funding it by their own money, or they go take loan. Okay, so the part of funding which comes from the owner, we call it equity or capital. Okay, we are doing accounting for the business. Okay, so just to there is something very important concept in accounting is, the business, we see it as a separate entity. Okay, we treat it as a separate entity. This entity has funding from the owner, from someone who found this business, and lenders. Okay, now when I come and do accounting, I'm doing accounting for the business. I'm not doing accounting for the business, the owners. I'm doing accounting for the business. Okay, so in business, now the business, now the entity, the separate entity owns or owes the owner and the lenders. Okay, so the part of owner, we call it equity. And since, as we said, they are separate, so the business has liability toward the business owner. So the equity in the business is a liability for the business. Equity is a liability for a business. Okay, with loan, we pay interest. When we take loan, when the business take loan, they pay interest, but the owner will make profit. We pay the owner the profit the business makes. Okay, so the profit which comes in the business is a liability for the business. It's a profit for the owner, but it is a liability for the business. Okay, because the owner has the right of over it. Now, the difference between financial accounting and management accounting, you will take management accounting as F2, maybe not after F1. After we finish F1, we'll do F2. So the difference is financial accounting is just bookkeeping, reports, preparing, using historical information. Here we are doing historical information. We are using historical information to create our statement. Nothing to do with how to run the business or control its operation. Okay? Financial accounting, it does not do anything about business, running the business or controlling the operation of the business. The management accounting, uh, they have more work. They do more work than financial accounting. Uh, they do they check they use financial accounting statements. They use that information. They also get information from other sources, for example, the competitors. Okay, to compete, they want to see the competitors. They plan for budgets. They manage the operation. They control the expenses. They make plans. They take decisions. Okay, which is cost accounting also we say. Okay. Statement of profit and loss. Okay, we'll talk about statements now. So we have statement of profit and loss, SOP, I, okay, or L, sorry. We record all the expenses and incomes. What the items are included in the statement of profit and loss is uh, in expense and income. Okay. And revenues is the income generated by the operation of the business for the period. Okay. Generally, these statements are created for 12 months. Okay. Some could create quarterly, 3 months. Every 3 months they create. And the assets, um, okay, this is a definition from the book. I'll go back to the book and we will do some exercise. So first of all, let's do this one here. Users of financial statement. Okay. Or let's see what statements are correct here or false, true or false. Shareholders receive annual accounts prepared in accordance with legal and professional requirements. Okay, is that true or false? Accounts of limited liability companies are sometimes filed with the of companies. Register of company. This is an authority in UK. Okay, here in Bahrain we have سجل التجاري that we records all this detail of liability and limited liability companies. But in UK they call it registrar of companies. Okay, employees always receive a company's accounts and an employee's report. Okay, that is this true or false? The tax authorities receive as much supplementary details as they need to assess the tax payable on profit. Is that true or false? Banks frequently require more information than is supplied in in the published accounts when considering application for loans. So, is accounting information is enough for the banks? No, it's not enough for the banks. Okay, so yes, they might require more information for them to give you loan. Okay, tax authorities receive much as supplementary. It is not the work of a tax authority to create or to check how much tax you are supposed to pay. The accountant who created this statement, he will mention how much he will be paying tax on the income he have generated. Okay, so that is false. Employees always receive, not necessarily employed, maybe employees receive a company's accounts, but not necessarily they will receive every time, always employees report. Okay. The accounts of limited liability companies are sometimes, not sometimes. If it is limited liability company, they are must. They always register with the registrar of companies. Okay. Shareholders receive annual accounts prepared. Yes, they get this account, this statement annually according to the legal and professional requirements. Okay, so this is true. Okay, so now I'll go to book. Let's see what we have in book. Important things that I want you to focus on. So most the main topics or the main ideas we have already discussed. We'll just go through the book and see if there is something that we need to uh, go through it again. So, as I said, if you find a definition, if I say definitions, you have to go the definition with the which is mentioned in the book. So, financial reporting, for example, financial reporting is a way of recording, analyzing, and summarizing transaction of a business. Okay, so this is financial reporting, financial accounting, and what is the difference between management accounting. We have already discussed. Okay. Financial statements, as I said, financial statements, we have statement of profit and loss. In the profit and loss, we have revenues, expenses, okay, income, and then we have a statement of financial position. Okay, this is how sole traders. Now, type of businesses. Let's go back to type of businesses. We could have a sole trader, someone who started a business. He's the only owner. Okay, okay. He don't have any partner, so we call a sole trader. If he works with the partner, that business type will be partnership. If they go and register this business as a limited liability, so the business becomes limited liability. So what is the difference between sole trader and limited liability company? From its name, the sole trader is liable not just what he invested in the business. For example, if a sole trader goes takes a loan for the business and unfortunately he loses the business or there is a loss in the business or he go bankrupt, he's not just liable on what he put in the business. He will liable for what he owes to the lenders also. So the lenders will not just come and sell his property of business or property also, but they go and maybe they go and sell his own property also just to pay this liability. Okay. But when we go and register the company as a limited liability, so they have this advantage that they are liable to what they have invested. That much only they are liable. Okay, so something happens to the business, the authorities will not come for their personal properties. This is just simply differentiation between sole trader partnership and limited liability companies. Now, statement of financial position, as we said, asset. Now, asset, see, we have a definition here. So you will take the definition of the book. So asset in the book says, asset is a present economic resources controlled by entity, business, as a result of past events. Now, past events, what they mean about past events. So we have purchased this asset because we had need for this asset in the past. For example, we wanted to expand our production capabilities. So we had one machine, and then we to produce more goods, we have purchased another machine. So we have purchased this asset. Now we are using it, and now we own it. Result of past decisions. Okay. An economic resource is a right that has the potential to produce economic benefits. Okay. Machines that we have purchased, we purchase because it will give us economic benefit. Okay. Now, liabilities. Now, again, you will go with the definition of the book. Liability is a present obligation of entity to transfer economic resources as a result of past event. We have took loan, so we can purchase machines. Okay, we took loan, so we can purchase machine. Now we are liable. We have liability to pay that loan back. Okay, with interest. Uh, Equity, we have covered equity. Now here the definition of equity, residual interest in asset of entity after detecting all its liability. So the idea here is when company goes bankrupt, okay, when company goes bankrupt and it got funded by the owners, the equity owners and lenders, liabilities. So who has the first right on the asset of the company? the lenders. Okay, the lenders has the first right on the asset of the company. So when company has loan and it goes bankrupt, assets will be sold and the lenders will be paid first, then the equity owners. Whatever is left, then the equity owners will own that. Okay, that's why equity is residual interest in the asset of the entity after detecting all its liability. Okay, now what we have here. So this is simple, like income statement or balance sheet. We will do it. We will create it later on. Now, key feature of statement of financial position, uh, non-current assets. We mentioned non-current assets. We will take all this. What is non-current asset, current asset? Okay, we will cover all that. A relation between the statement of financial position and statement of profit and loss. We will cover that also later on, later chapters. Now, these are the users of this financial statement that we're going to create. Investors, they need statements. They use these statements. Employees, they use this statement. Lenders, suppliers, customers, governments, and public. So each of them has different reasons, okay, or maybe similar reason for having this statement or getting this statement from the company. Okay. Recording account. We have already covered this in the slide. Okay, and type of businesses I have already explained: sole trader, partnership, and limited liability companies. Now, in accounts here, whatever we're going to do next in coming chapters, we will talk about, our focus is on limited liability companies, because by law, they are the one who is required to create all these statements. Okay, so whenever we are talking about companies, we mean limited liability companies. Okay, later on. Now, this activity we have already done. Uh, Here, the concept of business entity, as I explained, we take business as a separate entity. They are not the same as the owner. Okay, and we are going to do accounting for the business. We cannot mix the owner's account with the business account. Okay, governance. We for now we just take it as a directors who is responsible for taking or making this a statement. The directors of the company, they are the responsible. They are the one at the end of the statement. Each statement they will sign. Okay, and they are the one who will be responsible of any misrepresentation of information in this statement. Okay, they will have employees under them who are creating and doing this work, but at the end, they are the one who is responsible creating of this asset or this statement. Okay, that's it. I think we covered everything in chapter 1. Okay, responsibility of financial statement. As I said, the director responsibility. There are some text here. You can just go through it, just read it. Okay, there is nothing memorization. You just read it, understand it. That's it. Okay. Uh, and I'll see you inshallah in the class.